Everyone, this is Logan with Hasseltine LLC. We are back with part 2 of our sample cash flow optimization exercise. So if you haven't seen part 1, please go back and look at it, where we freed up $24,000 annually for John Smith. So now that we've freed up the cash flow, how are we going to deploy this new cash flow as well as his already existing free cash flow? Let's take a look. Standard disclaimer, this is for informational purposes only, not investment, legal, or tax advice. Here's all of our contact information, and in general, we help our clients become their own bankers by utilizing the infinite banking concept. And let's just recap part 1 briefly. So John Smith is a 35-year-old male. He makes $150,000 gross annual income. He is a healthy non-smoker, self-employed. His current cash flow situation is he brings in $12,500 a month, and he spends $8,500 a month for a net monthly cash flow of $4,000. And here is the summary of how we saved him an additional $2,000 a month just by optimizing what he's already doing. That was covered in part 1. So now on net, he has $6,000 of monthly free cash flow. And now we are going to put that monthly free cash flow to work. And for simplicity's sake, for the sake of this exercise, we're not going to look at his liquid savings and his existing assets. We are actually doing this. We would certainly include that as well. And this is the framework we're going to be applying. This was also covered in an interview with Peter Nelson. But we're going to cover our bases, right? We want to start with protection, then savings, then investing, and then speculating. We want to make sure we set up our defense before we set up our offense, right? Offense wins games, defense wins championships. And playing defense, financially speaking, is a lot easier than playing offense. You just put an insurance policy in place and pay a premium. Very easy. Very easy. Very, very difficult to pick investments that are going to net you large returns. That's very challenging. All right, so this is our framework, and let's look at how we're going to apply it. Okay, so we're going to start by covering the most catastrophic event first, right? When you're looking at insurance or just playing defense generally, you want to cover yourself against the most catastrophic potentiality first. Not necessarily the one that's most likely to happen, which is what some people think, but no, the one that would be the most catastrophic if it did happen. And the more unlikely it is, the cheaper that coverage is going to be. Okay, so if some of these seem unlikely, well, good. That means probably the insurance will be very affordable. If they're likely, then the insurance company may not even offer you coverage because they have this thing called underwriting. Insurance companies don't take on risk, okay? They are only in the business of covering you against unlikely, potentially negative outcomes. Anything that they consider likely, they're either not going to cover you or they're going to increase the rate. So we're going to start with life insurance. Now, I just mentioned here these other things, home and auto, property and casualty insurance, estate planning, etc. I don't cover those, but I do partner with other financial professionals who can help so we can get those covered. But that's not what I personally do. But obviously you do need those elements in your plan. So life insurance, how much life insurance are you eligible for? Well, your human life value, also sometimes called your insurability, as it pertains to life insurance, is typically measured as a multiple of your income projected over your working years. Because what the insurance company is doing is they're trying to measure what is the financial loss to your dependents, okay, or to those who care about you, if you were to die, okay? And it's really the lost income that they were expecting over many years. So that is what they consider your human life value. Now, there are different ways of calculating it, but this is typically, if you're still in your working years, the way to calculate it. So in this case, John, at 35 years old, is eligible for a death benefit equal to 30 times his gross annual income. Okay, so he's 35. He might be working until age 65. If we project his income over the next 30 years, that's his human life value. And I just want to point out that's a pretty conservative projection, right? Remember, no insurance company is ever going to promise to make you completely whole. This is why they have deductibles, because they do not want you to be incentivized to file a claim. Okay, they only want you to file a claim if you really have to. Okay, so maybe you have a $1,000 deductible on your homeowner's insurance. So if you file a claim, of course, you got all the hassle of dealing with the claim, and you did come out of pocket for $1,000. You did suffer a loss, but instead of it being a $250,000 loss, it's a very manageable $1,000 loss. Same thing applies here. So whatever the insurance company tells you your human life value is, they are, of course, underestimating it, all right? Because we're assuming here that John's income is not going to go up for the next 30 years. That's pretty conservative, right? So I would say whatever the insurance company offers you is what you should take. So in this case, again, $150,000 of income that he's making times 30 working years makes him eligible for a $4.5 million death benefit. Okay. How we secure that $4.5 million death benefit, I'm actually going to save for the end, because there are actually a lot of different things we can do with life insurance that many people may not be aware of. We're actually going to get long-term care protection as part of the life insurance policy, so we're not going to be buying a separate long-term care insurance policy, although you can do that. And we're also going to get some significant savings and retirement income without taking on market risk. So we're going to cover all of that at the end. That will be the fun part. But just looking at it purely from an insurance standpoint, you probably want to secure life insurance first, because the most catastrophic event, of course, is death, and we want to protect ourselves against that first. Okay, next we're going to look at protecting his income, right? If I were to ask you, what is your most valuable asset, right? What's your most valuable asset? Most people would think about it, and then they would probably respond, my house, right? Or they would think of, what is the thing that if I sold it would give me the most money, right? And for most people, that's their house. But if you really think about it, your most valuable asset, and of course there is no one right answer to this question, but your most valuable asset, financially speaking, is your ability to generate income, okay? If you can keep earning a very high income or a comfortable income, right, that's very valuable to you, right? And you can weather a lot of financial storms that way. So if you have an asset, in this case, your income generating ability, that's making you $150,000 a year, wouldn't you want to insure it, right? If you had a machine that you installed in your house that produced $150,000 a year, wouldn't you want to insure that machine, right? And that's what we're doing here. We're ensuring your ability to continue to earn and generate income. And that's what disability income insurance does. So separately, we'll cover the policy in more detail. For the purposes of this presentation, I'm just covering some of the highlights. So first of all, you want an individually owned policy. Okay, you want to own things. You do not want to rent them from an employer, because that protects your insurability, and that policy now goes with you no matter where you go, who you work for, whether you're self-employed, or no matter what happens in the future. Own occupation can be a very valuable feature as well. This means that your policy covers you if you're unable to work in your primary occupation, but you might still be able to work in a different occupation. Okay, so you don't have to be unable to work at all in order to collect the benefit. Then, of course, residual, which basically means it'll cover a partial loss of income as well as a complete loss of income. And then non-cancelable is also very important. This protects your insurability. Okay, if you are still healthy enough to get insurance, you are still insurable. And that may not always be the case. Or maybe it'll just be a higher rate in the future, right? So you want to lock in your rate today. You're not getting any younger. Okay, a non-cancelable policy means not only can they not cancel the policy on you no matter what happens to your health, they cannot raise the rate either. Okay, and we'll go into more detail on these in a separate video. Okay, so for this particular policy, it's a very robust, individually owned disability income policy, and we're going to pay either $261 a month or a little under $3,000 annually to get that protection. Okay. So about 2% of the value of the asset we're protecting is what we're paying in premiums. Okay, and then next we're going to look at critical illness. In this case, John is eligible for a $500,000 benefit. Okay, and this is just a simple lump sum $500,000 benefit that he would receive if he has a critical illness, such as a heart attack, stroke, or cancer. Okay. And again, it's going to be individually owned, not rented from an employer, and we're going to protect his insurability so he can keep the policy in force no matter what happens to his health. Okay. So again, individually owned, not rented from an employer. Guaranteed renewable for life, right? That's really important. It almost sounds too good to be true. At 35 years old, it's pretty unlikely you're going to suffer a heart attack, stroke, or cancer, okay? But what do you think the odds are of him having that at some point while he's alive? Maybe in his 70s, 80s? Pretty high chance that that's going to happen, right? So this ensures he can keep the policy in force for life, no matter what happens to his health. This one is indemnity-based, not reimbursement-based. So it's a very simple claims process. You had a heart attack, here's your money, right? No wrangling about, was this a reasonable expense? Well, that doctor's out of network, we don't cover that, blah, blah, blah. No, it's very simple and straightforward. You had the heart attack, here's your money. Done. Covers reoccurrence, okay? So this will cover you for multiple events, right? Not just one event. The policy doesn't end just because you filed a claim. The policy stays in force. And return of premium. So if you take out the policy and then you die in a car accident, never having used the policy, the premiums you paid in are returned to your estate. So it's quite literally a no-lose proposition. Either you use the policy when you have a critical illness, or those premiums are returned to your estate. But one way or another, it's guaranteed, if you keep the policy in force for life, which you should, that you will get at least as much out of the policy as you put into it, if not more, if you can think long range enough. And this particular policy comes with a approximately $500 monthly premium or a $6,000 annual premium. And now the fun part. We've saved the best for last, and there's a ton we could get into beyond this, but we're going to try and keep it as simple as possible for the purposes of this presentation. So we are going to cover both life insurance and long-term care, as well as savings and retirement income, all in one fell swoop. So what are we going to do here? Okay, so we are going to, as I mentioned, get all this plus starting his infinite banking system in this particular policy. And we're not going to show the infinite banking concept here. There's a lot more that comes with this. We're just trying to show some of the highlights. So there's a $4.5 million death benefit that he is eligible for, and we want John to be fully insured, right? You fully insure your house, you fully insure your car. Don't you think you should fully insure your life? What's more valuable to you, your house, your car, or your life? Right? If you're married, if you have children, what's more valuable to them, right? Your house, your car, or you being alive, right? And $4.5 million may sound like a lot, but if the family loses your income permanently, that is not a lot of money, okay? That's all they have to live on for the rest of their lives. There's a good story by Tom Hegna entitled The Widow Who Thought She Was a Millionaire. And you can read that story to understand why, millions of dollars in terms of death benefit may not be as much as you think if that's got to last you for the rest of your life, right? So anyway, $4.5 million of death benefit we're going to get because that's what John is eligible for, and we want him to be fully insured. So we're going to take out a combination of two policies, a $1.5 million whole life insurance policy and a $3 million convertible term policy, so that between these two, he is fully insured. Okay, so again, we'll cover this in more detail separately, but some of the key points. So that whole life policy comes with what's called a chronic illness rider, which basically allows you to advance yourself a portion of the death benefit if you have a long-term care need. And people are starting to wake up to the fact that if you don't have a long-term care plan, you don't have a retirement plan. You need to have some protection in place in the event of a long-term care event. And the beauty of this rider is that it's not use it or lose it. With a pure long-term care insurance policy, which is a good thing, you pay premiums, right? But if you never use it, you don't get any of that money back. Here, you can't lose the money, right? If you don't use it, it just stays with the death benefit and your heirs get it, right? Or you can use it in terms of the cash value while you're alive. So no matter what, that money never leaves your personal economy, okay? So this can be a great, very flexible way to cover you should you have a long-term care need. In addition, from that whole life policy, we are going to get $1.6 million in projected tax-free retirement income from the age of 66 to 85. If we assume John retires at age 65, this will give him 20 years of retirement income, tax-free, totaling $1.6 million, and there will be $1.3 million left over when he's done. Keep in mind, we're taking on zero market risk when we do that. That projection is not assuming the S&P 500 does anything. Okay. So the term policy comes with about a $50 monthly premium or about $600 annually. The whole life policy comes with a $25,000 annual premium. And when we structure this, the way that we typically look at it from an infinite banking standpoint is we back into the death benefit, right? We structure the whole life policy according to your current cash flow situation in terms of the premium and how the cash value grows in the policy, and we back into the death benefit. And then however much of your total eligible death benefit we do not secure through the whole life policy, we add that convertible term policy to get you fully insured. This is typically the way it works. Okay, so now we have gotten John some very robust protection in place, as well as savings. We really covered the savings portion of the pyramid as well, because whole life insurance, properly structured, covers not just protection, but also savings, and also your banking needs, right? Which, of course, we can't really cover here. But now John has himself protected. He's set up his defense so that he's in a great position to now play offense when he wants to. Here is a summary of what we did. So we took his $6,000 in monthly free cash flow, that's $36,000 annually, and we've now protected all of his most valuable assets, especially his income and his insurability, and when we set him on the path to a comfortable retirement through the properly structured whole life policy without taking on market risk and without paying taxes on it. Okay. Now, when it comes to the whole life policy, okay, for simplicity's sake, as I mentioned before, we are not including any of his existing assets or liquid savings, okay? But it could make sense to use some of that in various ways to fund the whole life policy, since the whole life policy operates like a savings account on steroids, and actually much more than that. It can make sense to take your liquid savings out of an inferior savings vehicle into this superior savings vehicle. But this is just a summary of the premiums we're now paying, right, into these policies and what it's giving us, right? So that term life insurance policy is getting us $3 million of death benefit and the conversion privilege. That's important. We have the guaranteed right to convert that term policy to whole life at any point in time. So that protects John's insurability. Should something happen to his health, he still has that guaranteed conversion privilege. And then, of course, as he expands his infinite banking system, he can convert that term policy to his next whole life policy. Okay, and then we're putting our $25,000 into this whole life policy that gets us so many different benefits: a tax-free savings account on steroids, the ability to borrow against the policy without interrupting the growth in the policy, right? So it's really like we bought some risk-free cash flowing real estate. Of course, it comes with that $1.5 million death benefit should, God forbid, something happen to John. Protection against long-term care events. In this case, we're projecting $1.6 million in tax-free retirement income from that policy. And after we take all that income, we'll still have $1.3 million left over at age 85. That's what's projected. And again, that is not assuming anything about the market. We're not taking on any market risk. Okay, the cash value grows based mostly on what's called actuarial math, not assuming anything about the market. And then disability income to cover his $150,000 worth of income, and critical illness, $500,000 benefit should something happen in terms of heart attack, stroke, cancer, etc. And again, his insurability is protected and locked in. He's still young enough and healthy enough to get insurance. We've now locked in that rate at his current age and health, and we've locked in his insurability. So these policies stay in force no matter what happens to his health. That term life insurance policy is a 10-year term, but should something happen to his health over the next 10 years, he still has the guaranteed right to convert it to whole life. So his insurability is protected. And that was it for this presentation. In the next part, we'll actually go into a bit more details on the specific policies and riders that we've placed on John here, but I hope you enjoyed this presentation. Here again is our contact information. Please feel free to reach out with questions anytime. I look forward to speaking with you. Bye-bye.